Natural gas prices closed last week at $3.81, marking an 8.5% decline as the market reacted to forecasts indicating above normal temperatures for March. This drop comes after a strong rally throughout February, which was largely fueled by concerns over tight storage levels and the potential for supply constraints. However, with weather models now signaling a shift toward milder conditions, heating demand is expected to ease, reducing the upward pressure on prices. As a result, the market has turned lower, reflecting traders' recalibrated expectations amid a changing fundamental landscape. Meanwhile, weather forecasts continue to exert bearish pressure on the market, with analysts projecting above normal temperatures spanning from the Rockies to the Atlantic during the March 10-14 period. This unseasonably mild outlook is expected to curb heating demand, further weighing on prices. As the winter season nears its end, concerns over weakening consumption are growing, amplifying downward pressure on the market and tempering any potential bullish momentum. Moreover, nat gas production remains strong, with the U.S. dry gas output reaching 107.8 billion cubic feet per day, reflecting a 2.8% increase compared to the same period last year. Prices continue to decline, despite LNG exports still providing some support, with flows to U.S. export terminals at 15.6 billion cubic feet per day, a 2.1% week-over-week increase. You've probably heard the buzz that natural gas prices are expected to be higher this year due to a long-term bullish factor, the Trump administration lifting the Biden-era pause on approving new LNG export projects. Bloomberg, for instance, recently reported that a decision on the Commonwealth LNG facility in Louisiana is approaching, which could eventually boost U.S. natural gas demand. But let's take a closer look at the timeline. I checked the roadmap, and what a surprise, Commonwealth LNG isn't scheduled to start production until 2029. So, how exactly is this supposed to drive prices higher this year or even next one? The market speculation around this seems more than a little exaggerated. Okay, some might argue that the US is the world's largest LNG exporter and faces little competition in the market. But let's take a look at the 2025 roadmap, and what a surprise, both Canada and Qatar are set to flood the market with significant LNG volumes this year. So much for the idea of a competition-free landscape. Moreover, the anticipated feed gas demand growth from near-term US LNG projects may have been delayed, with projections initially suggesting an increase of up to 2.5 billion cubic feet per day. However, a more realistic estimate points to just 1.5 billion cubic feet per day by year-end, depending on the precise ramp-up schedule for commissioning terminals. Finally, as Bloomberg has noted, the LNG market could face an oversupply issue in 2027, driven by the completion of a series of delayed projects in Texas and Mexico, along with the completion of Russia's Arctic LNG 2. These factors are expected to contribute to a significant supply glut by that time. Meanwhile, the recent public clash between Donald Trump and Volodymyr Zelensky has introduced new geopolitical dynamics that could affect gas and oil prices in the near term. If US-Russia relations improve as a result, it may open the door for increased Russian natural gas exports. This boost in supply could potentially help stabilize or even reduce global natural gas prices, easing some of the pressure on the market. Moreover, with EU storage levels below 40%, major European countries are considering relaxing storage requirements to ease supply concerns and stabilize prices ahead of next winter. Alright, let's take a closer look at the technical indicators. With warmer than usual weather curbing demand, the short-term outlook for natural gas remains bearish. One critical level to watch is the key pivot point at $3.70. If this support is broken, we could see the market testing the $3.40 level, where we might see some buying interest as traders step in. However, if that doesn't hold, the next significant support zone lies between $3 and $2.80. Within this retracement zone, we also have the 200-day moving average at $2.85, which is a crucial trend indicator. A breach of this level could signal a deeper downtrend, potentially setting the stage for further price declines. Traders will be closely watching these levels to gauge the market's next move. Well, feel free to share your thoughts in the comments if you think I'm wrong, or maybe even right. Please like, subscribe, and comment to support the channel. See you in the next one.